Hello, welcome back to this week's market update. Today is Monday, June 10th, 2024, and we had a very full week last week and a Fed meeting ahead, so let's jump right in. Stocks continued their rally last week on hopes that the US economy is headed for a soft landing. We had the May jobs report, the ISM Services Index, and the ISM Manufacturing Index, all being major data releases of last week. As of close on Friday, June 7th, the Nasdaq Composite was up 2.4% on the week, the S&P 500 up about 1.3% for the week, the Dow Jones Industrial Average up slightly 0.3% on the week, and even the Barclays Ag up slightly 0.1% as of close on Friday. Heading right into this week's market news, we had the May jobs report on Friday morning last week, where we saw the unemployment rate unexpectedly tick up to 4% here, which is still quite a healthy level of unemployment, very natural, that many economists say is, very healthy and just kind of normal turnover of the labor markets. And then on the other hand, we had the non-farm payroll gain total in at 272,000 in May of new jobs, surpassing the estimates of 180,000. So in one respect, we have unemployment rising. However, the number of new jobs surpassed estimates. So how does this happen? Typically, it only happens when more individuals are entering the labor force. So that could be for a wide variety of reasons, but ultimately, the unemployment rate has been slowly creeping up, and we'll take a deeper dive at that in the next slide here. But at the same time, the number of new jobs added to the economy each month have been growing. Panning out a little bit further than just the May data alone, here you can see the 1-year percent change in unemployment. So obviously we had that huge spike post-COVID when the unemployment rate shot up as many companies furloughed and laid off many employees with not knowing how the pandemic was going to turn out. And then that slowly dropped off into mid-2021. And ever since then, it's been on a slow but steady upward trajectory of the unemployment rate. So still at a 4% unemployment rate, quite healthy, very natural, not anything that economists are concerned about. However, this 1-year percent change is often a very good telltale sign of where the labor market may be headed. You can see since about early 2021, where we were at this bottoming point of the 1-year percent change in unemployment now, ever since about summertime of 2023, where the 1-year change in unemployment, the 1-year percent change in unemployment has been actually positive. So although it's been quite low, maybe about 8 to 10% higher than it was the year prior, this is an upward trend. So it'll be interesting to see if it continues to go up or if it just kind of stagnates out and it levels out to about a 4% unemployment rate and the US does actually achieve that soft landing. In other news this week, we had the ISM Manufacturing and Services Index both post last week for the month of May, and both continuing to show a very different picture of the economy depending on what sector you are in. So in the manufacturing sector, it's continued to be quite sluggish. You can see in May's reading, we had it come in at 48.7, which is lower than expectations and also shows contraction in the industry. Anything below a 50 generally shows a contractionary industry, while anything above a 50, which you can see here, we had that for 1 month in March earlier this year, is an expansionary indicator of the sector. So overall, we've seen in the past year, 2 years or so, everything's generally been below 50. And if it was above 50, it was just ever so slightly above 50 for 1 month at a time. And overall, within the index for May, the main drivers of this decline was a lack of new orders as well as backlogs declining. So companies are seeing a little bit of diminished demand and they are meeting that demand from previous orders. They're catching up to their backlog of orders. So overall, very soft picture in the manufacturing sector, and we'll take a look at services next. The ISM Services Index painted a very different picture than the manufacturing one, essentially showing the flip side of the story. So in May, it came in above expectations at 53.8, so quite a very Very strong month of growth there, and this follows 1 month of decline, 1 month of contraction in April that we saw. So, kind of the flip side of manufacturing, where we have seen mostly negative readings, and we had just one outlier of a positive reading in March. And in services, we've had mostly positive readings and 1 month of an outlier in the month of April. So, very interesting stories there. This actually marked a 9 month high in the ISM Services Index, the highest since August of 2023. So that's good for the service side of the economy, which actually makes up the majority of the US economy. And within the index, we saw increased business activity as well as new orders for services drive the index higher in May. So, really a tale of two very different sectors when we look at the ISM services versus the manufacturing. Last but not least, we had the European Central Bank cut rates, we had the Bank of Canada cut rates, and a few other banks already starting to cut rates, with those two actually beginning their rate cutting last week. The June Fed meeting will be very important this Wednesday, June 12th, to guiding how the market behaves in the coming months, as well as to the expectations for interest rates over the coming year. So currently, the market is pricing in a 51% chance of a cut by the September meeting, and this is as of Friday last week. So we still see a 49% chance that the first cut will come after September, and then a 4% chance that we'll see two cuts, two 25 basis point cuts by or during the September meeting, and then a 46.7% chance that we'll see just one rate cut, usually most commonly expected to be during the September Fed meeting. So overall, really important week last week, important week ahead, and we're going to continue to stay up with the market news. We thank you so much for tuning in, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.